Hello, everybody. This is Jacob Amezcua from Motel to Apartment Conversions, and today we're going to be doing a deep dive into our proforma. During this session, I'm going to go through every single one of these tabs, and we're going to go through every cell, and we're going to analyze what is going on in this proforma, let you know how we underwrite deals, and specifically, today we're going to go through the 702 North Sam Houston Parkway hotel conversion. So let's jump right into it. The Overview tab. This basically is just a regurgitation of everything else in the spreadsheet. So if you're going to look at one tab, look at this Overview tab. First, we'll start with the total project costs. And so we bucket out our costs into 4 different sections: our acquisition costs, renovation costs, reserves, and fees. And so you can see for our acquisition, it's a $3.6 million purchase price. That's roughly a little under $30,000 a door. You can see any loan origination fees. In this case, it's a seller finance deal, so we're not dealing with any type of bank debt, no loan origination fees, any legal costs, LDs, pre-closing activities, etc. Then we see our renovation costs. I'll jump into this in a little more detail in the inputs tabs, but you can see our renovation costs, any reserves that we want to take, so any type of operating capital reserves, leasing commission reserves to lease up the property, any type of debt or interest payment reserves while the project is happening. It's accounted for here. You see our fees here, the fees that the GP takes: project management fee, acquisition fee, asset management fee. We'll go through that in a minute. Then you can see our capital stack. So for this deal in particular, like I said before, it's a $2.6 million purchase price. The seller is carrying that. It's a 12-month note. And the total project size is $7.4 million, as we can see here. So the difference between the $7.4 million project size and the $2.6 million note is $4.8 million, which is the equity needed from investors. If you go to the top, you can see the total deal return summary. So the IRR on the total deal, $4.8 million in equity in, 12.2 total returns back. So that's a 40% IRR, 2.54 equity multiple, 51% annual rate of return. And then what most investors are interested in is the actual investor return summary. So for this deal, we only have Class A investors. So this is what investors can go into this deal expecting. The total investment, like I mentioned, is $4.8 million. The total returns, including the return of capital, is $11 million. So that comes out to a 35% IRR and a 2.28 equity multiple with a 42.7% annual rate of return. So if you scroll a little bit to the right here, you can see how a $100,000 investment would perform if we hit all of our benchmarks in the pro forma. So you can see here the preferred return that's returned to the investor: year 1, year 2, year 3. This is a 3-year project. You can see any return of capital from the refinance, any return of capital from the sale and when that's going to happen, any proceeds from the refinance, any sale proceeds from the refinance. Any sale proceeds from when the property is dispositioned, and then the cash flow, which is an 80-20 split, which we're going to go through in a minute. And so you can go and see the total annual returns year by year for an investor who put in $100,000 is projected to be close to $12,000 year 1, close to $12,000 year 2, and $204,000 year 3, for a total project return of $227,000. So that's just an example that you can look at here. You can actually change this number. By the way, you can download this spreadsheet and you can change any field that's in blue. I'm going to talk about in a minute, but any field that's in blue, you can download it and you can manipulate it. So that's the Overview tab. LP Investor Terms tab, it's pretty self-explanatory. You can see for this deal, we are offering an 8% preferred return, an 80-20 profit split to investors. There is no hurdle, so the 80-20 split will continue. And then 4% project management fee. That's a one-time fee based on the total project size. A $150 acquisition fee, $150,000 acquisition fee, a 0.9% asset management fee, which is an annual fee based on the total project size, and then a one-time $30,000 advisory fee, which we pay to our partners. So then that's the Overview Investor Terms tab. The Inputs tab, this is where everything is inputted. We shouldn't be inputting anything else other than the Inputs tab, which makes it really nice for us. By the way, we did create the spreadsheet from scratch. We created it ourselves. We had a third party as well create it. We've had many checks and balances, and it's the spreadsheet is very ironclad. We're very, very proud of it. So like I mentioned before, you can download this. You can edit anything in blue. So let's jump into the unit mix. So we're able to get very granular in our units. And so you can see here that there's a bunch of different 1-bed, 1-baths. And the reason for that is because they all have different square footage. And so there's a 1-bed, 1-bath that's 398. square feet, 449 square feet, 429 square feet, etc. And so we're able to see exactly how big each of these one bed, one baths are. And then we have our studios here. We can see the as-is rents. So we see studios as-is are renting for $850 a month in this hotel. And the one bed, one baths are all averaging out to be about $1,000 a month. So it's already very good. We're going into this. It's about 50% occupied, which I'll explain in a bit. But we're going into this and it's already performing pretty well. We could see what the market rents are for this type of an asset. And then we could see what our pro forma rents are. And so you'll notice that our pro forma rents are always slightly lower than the market rents. We want to stay very conservative. And so we usually try to stick to 10% lower than what the market is. And then you can see our as-is rubs and ancillary fees and what our pro forma rubs is and ancillary fees. And so then we get down to our total pro forma rent price. And so what we do that's a bit unique, we don't charge back rubs. Well, we do charge back, but it's not a line item on the lease agreement. It's not a line item for the tenant. The tenant just gets one bill every single month, and this is the number. And so that's how we underwrite. We like to see what our rubs are. We like to see what our rents are. But on the back end, the tenant is only going to see this number that they have to pay each month. And so then we go to the reno costs. The studios, $15,000 in reno, and then under $14,000 in reno for the one bed, one baths. The reason the studio is a bit more is because we do have to build a wall. We're not putting any new plumbing into any of these. They all have all the plumbing necessary required to do what we want to do. The one bed, one baths, the majority of them already have kitchens. We're just updating the kitchens. The studio, we're doing something creative. We're actually sectioning off the sink that's in the kitchen, the sink that's in the bathroom. We're building a wall, and so the sink that's in the bathroom is very, it's set pretty far away from the toilet. And so now we're building a wall in between the toilet and the sink. And so all of a sudden the bathroom becomes just a toilet and a shower, and the sink becomes part of the kitchen. Then we don't have to add new plumbing or anything. And so very creative there, but it's on average will be about $14,000 across all the rooms with $3,000 FF&E. And we are going to be furnishing each one of these rooms, which sets us apart as well. And so for any type of other income, there is a commercial kitchen and dining area. We're not factoring that into our pro forma. If we can lease that out, great. It's just extra income, but we just want to be cautious and not plan on getting any income from that because it's not generating income right now. So you get down to our operating income. So you have our revenue, our gross potential rent. So you see the as-is that pulls from the above, as-is annual, as-is month, and the stabilized annual, stabilized per month. And you have our other income, which would come from the restaurant or the kitchen that we don't have on this one. And then any type of vacancy loss. And so currently this property is operating at about a 50% vacancy loss. So it's actually cash flowing. It has pretty decent income every month, between $40,000 and $60,000 income every month after everything, concessions, any uncollected rents, etc. And so for us, we're staying conservative at an 8% occupancy rate. We have 1% accounted for concessions, 1% for bad debt or uncollected rents, 2% for any other unexpected income loss adjustment. And stabilized, we're looking at an annual 1.8 million in just gross revenues. And then we go down to our operating expenses. So taxes, electric, gas, water, waste, turnover. We're very close on the as-is operating expenses. Like I mentioned before, it's actually churning out an NOI, so it's cash flow positive right now as we're acquiring it. So that's great. And then we put stabilized expenses based on what the as-is expenses are now, and also based on what our properties are performing at our other properties. So our Brownsville property, we're currently managing that. That's an 80-unit hotel that we're currently converting into apartments. It's operating at a 36% operating expense ratio, which is great. So on our underwriting, we usually go through every line item, and if we get to the end, based on comparing the per unit stabilized to as is, if we're below a 45% operating expense ratio, we usually adjust to make that operating expense ratio higher, meaning that we want to project that there are going to be more operating expenses than we actually think that we're going to have. And so anything under 45%, we always add more miscellaneous because we want to stay safe, even though our other property is performing at under 40% operating expense. And so this is where we expect to be stabilized. Something very cool that I haven't seen any other pro formas do is we're able to month by month go through vacancy and concessions and debt and any other income loss. And in addition to that, we're able to put in a number of months that we until we expect it to be stabilized. And so I'll show you how that looks in the pro forma, but it basically is a ramp up saying, okay, let's take the as is monthly rents right now, how it's performing. And if it's going to take 12 months to get to our stabilized, we're going to do a loss to lease adjustment that increases every single month. And so it's very accurate in that we're taking the loss to lease and we're gradually increasing it until full stabilization. So I'll show you in the pro forma, it'll make a little more sense then. But we're able to adjust every single month vacancy, so it makes us very flexible into what our renovation strategy is going to be. We're going to immediately begin to lease these more than they're even leased now while doing renovations at the same time. And so we expect to maintain about a 60% occupancy, so 40% vacancy loss during the 12 months of stabilization while we do that. So that's our vacancy there and how we are projecting to stay occupied. The source and use, you see here, this is kind of goes back to what I had showed first on the overview tab. It's a $3.6 million purchase price. We have legal costs, no LDs on this, no liquidated damages. We don't have to deflag this hotel. There's no branding on the hotel right now. And then pre-closing activities, is there any soft costs, any appraisals, commercial property inspections, architectural engineering, anything like that that goes into pre-closing activities. Our renovation costs, this $2.5 million renovation number is a sum total of all the room renovations plus this $450,000 in additional reno that are not rooms. We always add a 10% buffer, and so we have about a $250,000 buffer into this already conservative estimate. So that brings our average reno per door to a little under $23,000 a door for this project. We always take leasing commission reserves, and so to lease this whole thing up, let's plan that we're going to pay a $300 commission to get a room leased for a year. So we have leasing commission reserves. We have operating capital reserves in the case that we do not cash flow positive per month. We want to have these reserves, obviously, going into it. And again, we're setting aside, we're paying 12 months of debt payments all up front. So we don't have debt payments during the entire life of the 12-month project, which is great. We have our project management fees there. This is a regurgitation of what's on the overview tab. So the LP investor terms tab. So you can see the percentages here. You can see the actual dollar amounts here. So you can compare and contrast what the fees are going to be. And then you have our sources of debt. So again, we have a $2.6 million seller finance term for 12 months. And that leaves us with $4.8 million in equity to raise. Investor split, it's an 8% preferred return, 80-20 profit split. There is no hurdle, continues to be an 80-20 profit split to the investor. And there are no Class B shares in this property. So this is pretty cool. We are able to put a date into when we pay out our first preferred return payment. And so we're anticipating a month 12 preferred return payment payout. That'll be the first payment to investors. And so realistically, we will be able to pay a preferred return before then, but we do want to be cautious and set expectations that we are planning to pay out the first preferred return month 12, and anything excess that comes in from the property, it'll go into our operating reserves so that if something unexpected happens, we'll be able to have an extra source of funds that we can draw from instead of using all those funds to do preferred returns. We want to build our reserve fund during the renovation, the unstable timeline of renovation. And then you have our loan details, and so 7% interest rate, 25-year AM on a $2.6 million loan. There is no second mortgage. We can adjust what month we do a cash out refinance. So this will be a cash out refinance month 12 and a sale month 36. We can adjust it here. So in the refinance, we're actually planning on getting very low leverage. We're only having a $2.6 million loan going into it. We want to come out of this with a $3.2 million loan on month 12. So we want to stay, just because of the debt market right now, we don't want to get a huge debt obligation. We don't want to be highly leveraged right now. And so when we do the refinance, it's just enough to recoup the capital of the seller, pay the seller back, and then also just get a little bit extra to pay off the preferred returns to the investor. And so we'll catch up the preferred returns after month 12. And so that is that's the refinance. And then on the sale, we have it goes through what the sale is going to look like here. And so month 36 is the disposition, year of disposition, and we plan to sell at a 7.5% cap rate. You can see that our rent comparables, we're at a 5.7 on average for the immediate area. Houston in general is under a 5%, but we're staying very conservative and saying a 7.5% cap rate, which lowers the sale price, but we're fine with that because, again, we want to plan for the worst case scenario, and the deal still works very well. And so our sales price ends up being $113,000 a door, which is under market. Houston as a whole is $124,000 a door. Immediate comps are $118,000 a door. So we're under there, which we feel good about because we want to stay conservative. Total gross proceeds from sale, $10.4 million. We can see down there. And so that's everything from the inputs tab. Then if you go to the renovation breakdown tab, not much there's nothing to, well, we go through and we enter in every single detail. We enter in what section it is, the material cost, any sales plus tax, any links that we have for materials, what the labor cost is going to be, the quantity. We go through, we're very thorough here in our renovation breakdown. And so it just mirrors the numbers that are on the inputs tab here. Rent and sales comparables. The biggest sales comp we have is In-Town Suites. It shares the same parking lot as us. It's 149 units. There's only 2 to 3 available at a time. We call them every other week just to see what their occupancy is. They're performing very, very well. They're all furnished. They're smaller than our units. Our units the majority are 1 bed, 1 bath. They're all studios. And out the door, after all the rubs and ancillary fees and taxes, they're at $1,700 a month. Again, on our proforma projection, on average across all of our apartments, we're under $1,400. We're at $1,381. And so this is the comp that we care most about because it shares the same parking lot. It's a similar type of hybrid long-term stay with month-to-month leases. And so that's kind of what we're going off of. We do have some other comps here as well. They're at or above what we're projecting as well for rent. So, but we're very confident going into this because of that comp that shares the same parking lot. And then down here you can see the sales comps. And so the best comps here are the ones between 4 and 9 miles. They have an average per unit price of right around what we're projecting, right around 113,000. The cap though is much lower, and so we are able to charge more income just because we're all furnished and we have a higher price per square foot for our rental. So we have a higher rent price per square foot, and so even though we're projecting such a higher cap rate, the purchase price ends up being a little bit lower, or the sale price ends up being lower than what the market is. If we were to lower that to a 5.5 cap or 5.7 cap, I mean, this would be an absolute grand slam. And so we want to stay conservative at a 7.5 cap. The pro forma, it goes month by month. So you can see every single month of this project and what happens. You can see the green refinance month. If you scroll over, you can see the green sales month. It all populates automatically. And how it works is that let me zoom out here for a minute. How it works is that it takes over everything that was in the inputs tab. Oh boy. Whoa. Did everyone see that? And it starts at the top. We go income, what our income is going to be every month. And I mentioned before the ramp up. So we put month 12 as our stabilization month. And so how this works is that on the loss to lease adjustment, it says, let's start with what our current rents are, and let's take 12 months to get up to what our pro forma rents are. And so this number that you see here, the 51,000, 46,000, that is taking a negative every single month on loss to lease up until we hit our pro forma rents. And so month 12, there is no more loss to lease because we're at our pro forma. And then our vacancy, in addition, is taken out of our rents each month. So this is, again, we're projecting 40% vacancy. And so this is 40% taken out of the total rent and loss to lease adjustment. And we have any concessions, bad debt, etc. Operating expenses, we take the full pro forma amount month 1. And so we're just expecting to ramp up expenses immediately. And that's fine because it still works. And then our total operating expenses, first few months up until month 12, we're almost just right about that break-even point. It could go either way. We could spill over, or we could be more profitable than we think. But up until month 12, we're not planning on being very profitable. But under this conservative pro forma, we have a net operating income of positive. And so if you go through, we'll look at this unlevered cash on cash yield because that's always fun to look at. After the refinance upon stabilization, we're at about a 21.7% unlevered cash on cash yield, which is great. Then you have your debt service after all of your expenses. So you have your principal, your interest, your DSCR, any debt reserves that you're using, it accounts for it here. So like I said, we are paying up front all of our debt payments, and so we won't have any debt payments for the 12 months that we're doing the reno. So that's great. And then we have our final cash flow available for distribution. Then we have our levered cash on cash yield. And this is awesome. So we're taking very low leverage at the refinance. Even taking that low of leverage, we're at 15% cash on cash yield for the project. So if the debt markets are looking better in 12 months and we want to take out a little bit more of a loan, this could be well into the 20% just because we're so low on our loan value. So a lot of room there Then we have our asset management fee, and finally our total cash flow available for distribution to the investors. And so for the first 12 months, we are putting any available cash flow back into our operating reserves. Again, we just want to make sure that we plan for the worst and set expectations. And then on the refinance, you can see here that all the refinance proceeds do go to the investor. That catches up the entire preferred return amount, and it also ends up in some additional, a small amount of additional profits flow on the refinance, and then you continue to receive preferred returns and cash flows up until the sale. And so you can see here the waterfall. So just to make a long story short, the investor gets their preferred return, then they get the return of capital, and then they get their profit split, and then the GPs finally get paid. And so nothing is paid to the GPs until there's a return of capital from the investor plus their preferred return, and then we split the profit. So you can see down here how that waterfall looks. And you can see the sales proceeds split. You can see the cash flow split. There's no hurdle. And then you scroll all the way down to the bottom, and this is a mirror image of what the overview tab looks like that I was showing very first on the total deal, the Class A shares. There are no Class B shares, the GP. So that's the pro forma loan summary. Very simple. It goes through what the seller finance loan looks like, what the refinance mortgage looks like. Same with the mortgage table. Goes month by month. Annual cash flow returns. This is kind of cool. You're actually able to plug in the exact number that you invest. And so let's say you invest 100,000 into the deal. You can see year 1, year 2, year 3, what you're going to get back. If you invest 25,000, you can see what you're going to get back every single year, or 2,500 even. So you're able to manipulate that. Quarterly cash flow returns, same thing. So that is a deep dive onto the pro forma. If you've made it this far, thank you very much. I hope you can see that this is a great deal, that we're being very safe on it. And so please reach out to me with any additional questions, and we're happy to walk you through anything else that you want to know. Okay, thank you. Bye.